Number one, a piece of machinery was bought for $4,000. It is to be depreciated at a rate of 10% per annum using the straight line method. Very, very important. What method is being used? What will be the net book value of the machinery after 2 years? All right, so this is supposed to be pretty straightforward. Use a formula, plug in the information that you have, and then work out the rest. Cost, and they're actually going to use the cost by depreciation format instead of the cost minus residual value all over useful life, right? It's all the same thing. So the cost was 4,000. The depreciation percent is 0.10 or 10%, right? That means your depreciation for the each year is going to be 400. Using the straight line method, you will have the same depreciation each year. So it's easy to get the amount of depreciation for 2 years. Just multiply the 400 by 2. That's going to give you a depreciation for the 2 years. Once you know what your depreciation is for the 2 years, just deduct that from your cost to get your net book value. So that's going to be 4,000 minus 800. And there you have your net book value at the after 2 years, at the end of 2 years. Snap. All right. 2, a machinery was bought for 20,000. It is to be depreciated at a rate of 10% on cost per year. So this is the straight line method. And using the straight line method, we know what I just said, same depreciation each year, right? There's a couple of ways you could do this. I'm going to show you both ways now. So depreciation is 10% by the 20,000. They told us that. So depreciation for the year is going to be $2,000. Right? We can now go use our formula. Depreciation equals the cost minus residual value all over the useful life. We have no residual value, so that's going to be 0. So in our costs, any brackets, we're going to have cost by itself. That's the 20,000 I have here, where you see the cursor moving. The useful life, we don't know what that is, so let's let that equal to y. All right, we want to get the y by itself. So first thing I will do, in the simplest of formats, I'll bring the y across by the 2,000. I'm going to end up with 2,000 by y. That's going to be equal to 20,000. Then I'm going to move the 2,000. And once you move something across the equation or across the equal sign, it becomes the opposite of what it was. So we had multiply by 2,000. When I bring it across, it's going to become divide by 2,000. All right, your math's coming in there again. So 20,000 divided by 2,000 is 10 years. Now, as a student, you can realize that, okay, my depreciation is 2,000. My cost is 20,000. All right, there's only so many times 2,000 could go into 20,000. Each year I have to take away 2,000. I could just divide my 20,000 by my 2,000, and that's going to give me my useful life. Or you could do what I did before here, which I'm highlighting in red, and actually work it out. This is the logic behind just taking the year, just taking the cost and dividing it by the amount of depreciation per year, right? So what you see on the screen in red, that is the logic, that is the steps for just, some person may tell you just take the 20,000, which is the cost, and divide it by the amount of depreciation per year. Why do you do that? This is why you do that, right? That's it in red. Another format you can use is realizing that the useful life is equal to 100%. Right? That's the max. So if my depreciation is 10%, as my depreciation factor, how many times I could get to deduct this 10%? Or how many times 10% could go into 100? Right? I particularly like to use this last method, like if you're just thinking quickly, you see something has a depreciation factor of 25% or 50% or 15%, you could just take the 100 divided by the depreciation factor, and that's going to give you your useful life. Whichever one works for you, please go ahead with that, whichever one is simpler. Number 3, a motor vehicle was bought for 30,000. They're expected to have a useful life of 10,000. At the end, they have a salvage value, depreciated using a straight line method. What is the annual amount of depreciation? This is really straightforward here again. The salvage value is the only thing that I could see making students be confused. The salvage value is the same thing as the residual or your scrap value. Pay attention to the language that they use, right? And they're going to understand that by doing a lot of questions. So if we just put in a formula, depreciation is equal to cost minus the residual value all over useful life. They give you all of that there. 30,000 minus the 8 divided by the 10. Your answer is A. Answer for number 2 is C, which is 10 years. And for number 1 was E. All right, so let's move on to number 4. Number 4, they're just checking to see whether you know what goes in the income statement, what goes in the balance sheet. Non-current asset at cost, 25,000. Provision for depreciation on non-current asset is 7,600. That is the total amount of depreciation which was deducted up until the 1st of January. Depreciation for the year is what you will get when it comes to the end of 2016, which is the 31st of December 2006. Sorry, right? That depreciation expense that occurred for the year, that is what you take and carry to your income statement. So your answer would be B for number 4. Number 5, pretty interesting question. Plant and machinery at cost 25,000, furniture at cost 7,000. Provision for depreciation, your accumulated depreciation. Plant and machinery 7,500. Furniture $1,050. Then they went on to tell us that depreciation is charged at a rate of 5% on costs for all fixed assets. How many years has the furniture already been depreciated? And this is what you do. Find the depreciation for the year. So 5% by the 7,000. That's going to give us 350. And then take your accumulated depreciation and divide it by your depreciation for the year. And that's going to give you your answer of 3 years, which is D. Number 6, a van was bought for 30,000 on the 1st of October 2006. It is to be depreciated at a rate of 20% per annum on cost. What amount of depreciation should be charged on the car at the 31st of December 2006? So I highlighted the 1st of October 2006 per annum, that means per year, and the 31st of December 2006. We are not going to find the depreciation for the whole year. They just want to get the depreciation for the 3 months that we had the car. 1st of October, so October, November, December, 3 months, right? But find the depreciation for the year first, which is going to be 20% by the 30,000. Find the depreciation for your month. So you take the total depreciation for the year, which is the 6,000 divided by 12. You're going to get 500 as the depreciation for the month. And then your depreciation for the period. Take the 500 per month and multiply by the number of months. You're going to get to 1,500. Here's an alternative method that you can use, which I'm going to highlight in red now. You take a 20%, multiply by the 30,000, and then you use your proportion or your ratio or your fraction, which relates to the amount of time or the period that you had the asset. Right? That's still going to give you 1,500. Answer here is B. Number 7, which depreciation method charges a fixed amount of depreciation each year? Reducing balance, as the name says, depreciation decreases. Diminishing value is the same thing as the reducing balance. And your answer here is straight line, because percentage on cost is the same thing as straight line. is not, percentage on cost is not a method, right? It is just a simplified version of the straight line method. So that answers number 8 one time. Which of the following is not a depreciation method? That is D, depreciation on cost. And number 9, what are the double entries to record depreciation on a fixed asset? Normally, what you can do is credit a provision for depreciation and debit the income statement. However, in real life, when you have a lot of assets, it's going to be tedious to have to debit your income statement so many times. It's going to make your income statement very cumbersome and frustrating or confusing. All right? So you can debit a depreciation account, find the total amount of depreciation by adding up all of the depreciation for the year, and then go transfer that to your income statement. If you want me to explain that a little more, just let me know. Drop something in the chat, drop a question in the comments, and I will explain that a little bit more. All right, number 10, which is the last question. An asset purchased for 1,000 is depreciated at a rate of 10% per annum using the reducing balance method. All right, so we're not going to have the same amount of depreciation each year. What is the book value of the asset at the beginning of the third year? Now, this is a past paper question. Very important. Something to note is that the asset value at the beginning of the third year is the same asset value you're going to have at the end of the second year. All right? So let's look at what I would have calculated here. I have cost. I start with my cost, which is $1,000. I take away my 10% for the first year. This is depreciation for the first year. Year 1, right, which is just 10% of 1,000, 10% per annum using the reducing balance. That's going to give me a net book value of $900. Good. And then I go find my 10% on that again. Depreciation for the second year, right, is going to be 10% of the 900. And when I take away my 900 from the, when I take away my 90 from my 900, that's going to give me my net book value at the end of 2 years, which is 810. Again, the value at the end of the second year is going to be equal to the value at the beginning of the third year. All right, so I hope that, you know, this was helpful and that you understand the 10 questions here.